Okay, so we're here, we're good. Welcome, everybody. I can't see you, so I'm not sure who's out there, but hello, everybody.
Hi.
So welcome to the State of the Markets for 2024. Okay. So let me give you my disclosures. Standard, security stuff. I work for Mosaic Wealth, so here's standard disclosure. Please don't let anything beep. Okay. For those of you that don't know me, my name is Greg Pedromer. So I'm a behavioral financial advisor and a registered Social Security analyst. So yeah, I kind of do both. I'm new with the Social Security and Medicare. So if you have any questions around that stuff, give me a call. I can help you. My professional life's work is to empower people around their finances. So build wealth, create financial security, and basically enable your dreams. My website is openvistasfinancial.com. And you can book a free consultation with consultationwithgreg.com. Okay. So with enabling your dreams and all kind of stuff. So what am I doing here? Learn the landscape of your finances. So everyone should have the opportunity to understand the full landscape of their financial situation. A lot of people don't know that, right? You know, bits and pieces, but a lot of people don't really know the whole thing. I'm hearing some noise. Is that me or is that, I guess make sure you're on mute. Okay.
Maybe mute everybody, Greg.
Can you do that? Oh, I can do it. Mute. Mute. No, that's only me.
I could do it if you make me a co-host.
Yeah.
Otherwise, just go to participants, click it, and then on the bottom it says mute. Oh, it doesn't say mute all.
Okay, can you hear me? Well, you muted everybody, so you can't hear me. Assuming you can all
Yes,
hear
we
me.
hear you. We hear you.
Thank you. So I muted all. So okay. And you didn't get Charlie in, right? So okay. Oh well.
I just sent him an email.
Oh, good. Okay, thank you. Okay, so back. Okay, so sorry about that. Okay. So different people have different degrees of familiarity with the markets, right? Some people know a lot. Some people don't know that much. So don't worry about it. We're here today to discuss things, and I'm always around, right? I'm here as a no pressure resource. So if you ever need help, just give me a call, send me an email. I can help you out. So if I meet with you, we can create a personal financial overview. Some of you guys have already done that with. Some of you guys have not yet. We'll go over your goals, investments, income, debt, all your information. Then we can learn how to minimize risk and seize opportunities tailored to your values, finances, and your whole life situation. It's a holistic thing, right? It's not just, should I invest in Bitcoin or AI now, right? You can set up a meeting with me with, actually it's consultationwithgreg.com. Sorry, typo there. Consultationwithgreg.com. Okay. So I'm a behavioral financial advisor. So what does that mean? Okay. Financial success has more to do with your behavior than your investments. Okay. Investments work, investors don't. And that's basically because people get emotional, right? Market goes up, they want to jump in. Market crashes, they want to jump out. So they get emotional and they don't usually do as well as just setting and forgetting. The only certainty is uncertainty with the markets, right? No matter what you think is going to happen, things change all the time. So you can't predict where the market's going to go, but you can prepare for it. Okay. And with behavioral financial advice, you align to your values. So we sit down, find out what your values are, and align everything to that. And we follow the smart money philosophy. So what is that? So it's making sure you have money when and where you need it. So the first one is death. Sorry, it's death. If you die, how do you have something to, life insurance, estate planning, all those things to take care of your spouse and kids and mortgage and all those things for your family. But say you live, yay. Okay. Then you could be sickness, injury, disability, accidents, anything like that. So you have health insurance, Medicare, disability insurance, long-term care insurance, all those types of things to handle that situation. But say everything, you're in good health, so we get to the markets. That's kind of what today's meeting is about, right? What do you do for good markets and bad markets? You know, investment planning, retirement planning, estate planning, all those things, educational planning. So my first thing here is, so what are 3 areas that you guys are looking for? Just kind of getting a feeling what's going on here. I should be able to do a poll. Here's my poll. Polls. Okay. Here. Okay. Can you guys see that? Did something pop up?
Yes,
Okay.
yes, it's great.
Good.
Let's
Okay.
see.
So pick 3 areas, including other, and you can write it in. So what kind of planning are you guys interested in? So investment planning is like, how should I do my investments based upon your risk and everything else, your goals? There's budget and cash flow planning. How do I spend my money? Is it aligned to my values? Retirement planning is, when can I retire? Will I have enough money? Family education planning is 529s. Insurance planning is your health, disability, long-term care. Estate planning is leaving money to your family. Tax planning is how I efficiently use my investments and leave money to my family. Okay. You guys been putting it in? I can't see if I can see anything yet.
I entered mine.
Okay. I got a bunch of zeros here, so let me end poll and see what happens. Looks like I have a bunch of zeros.
No,
No,
here it is.
it shows up. It all
That's
shows up.
weird. I'm only seeing zeros. It's only showing me zeros on everything. I can't see anything. That's really weird.
We
I
see
can't.
it.
I see it.
That's interesting.
83% for investment planning, 75 for budget cash flow, 67 for retirement.
Thank you. Okay. Okay. So we definitely need some retirement and budgeting and some investment stuff. Okay. Well, thank you. That's really weird. I can't see it, but okay.
And insurance.
Pet insurance?
Yeah, 17%, but
Oh, what do you
maybe that
say?
was
It said
me.
and
Maybe that was
insurance.
me.
Oh, and insurance. I think you said pet insurance. Okay. Okay.
Actually, my pet insurance paid $1,600 of a $4,000 bill, so
Very
it was,
important.
Yeah.
it was unbelievable, but I digress.
Yeah, we wish we had it. We just spent $20,000 on our dog and cats. So
Ouch.
yeah, our dog is too sick to get it. So
Hmm.
so thank you for your input on what to look at here. So it can be our agenda. So how did stocks perform in 2023? What drove the markets in 2023? Where are we now? And what are the forecasts for 2024? Okay, just it's interactive, so jump in whenever. Okay, so how did stocks perform in 2023?
A lot better than 2022.
That is very true. So my first question to you guys is, this is a test. How did the S&P 500 perform in 2023? So I'm going to give you a poll. Okay, can you see
I
that?
think you gave us the, oh, no, here it comes. Okay.
Don't worry
So
if you get it wrong.
we're supposed to know this answer, or are we just going to guess?
You're going to guess. something, this is the S&P 500.
Interesting.
Okay, since I can't see anything, I don't understand that. Have you guys answered?
Yes.
Okay. So sharing results. Okay. So what did you guys say?
24.
Was that the most common answer?
24 was the highest, and then 13.7 was the second highest.
Okay. Thank you. So the answer is they're actually all correct numbers. Okay. The Dow Jones did 13, the Russell 2000 did 15, the S&P 500 did 24. So whoever guessed that got it right. But look at the NASDAQ. The NASDAQ did 43.
Wow.
So you may have heard all these numbers because they're all valid numbers. But I asked you guys, what was the S&P 500? Because that's the most common one that people think about when they hear the market. Okay.
That's something else with NASDAQ. Wow.
Kicked ass.
Yeah. Oh my God.
Yes. And the prior year, it was down 33%. So it made it back and more. Okay. So this is what the big guys expected for 2023. This is back last year, 2023, right? So they were expecting it, Morgan Stanley said 3,900, UBS said 4,000. UBS was the highest at 4,000. So the average is 3,800. The market ended at 4,769. So they were all way low, right? They all guessed nowhere near what reality was. So be careful. Be careful when you hear estimates, right? Because nobody really knows, right? Because so what happened, right? So why did the market take off, right? At the beginning of the year, it looked really dicey, and so all the big guys were saying, "Yeah, it's probably not going to happen." So what did they think was going to happen? What was the big word? The big word last year, recession, right? Everybody said recession is going to hit.
Right.
It didn't hit, right? So that was a big thing. Interest rates, were high, but they were coming down, right? So that kind of helped out. What was the other big thing? Who made all the money last year? The Magnificent Seven, right? You guys know who they are? It's what Amazon, Apple, Nvidia, Microsoft, Google, Meta. I'm sure I missed somebody in there, right? So all the big tech guys made tons of money, right? But the biggest thing there was AI, right? AI really took off last year. The big guys knew AI was coming, but it really did much better than they expected. So that's why the market really flew. There's some problems, like banking industry had a little bit here and there, stuff like that. But that's why. So it really took off more than they expected. Okay. So our little group last year, we had a little quiz. What did we think was going to happen? So negative 10%, nobody said it was going to happen last year. 20% said it was going to be about the same. 40% went up 5%, 40% went up 10%. So we guessed better than the big guys. Our little group was a lot more aggressive and so we actually did better in our estimates than them. Okay, so what drove it? Okay, so this kind of just shows you what happened from the beginning of the year. It was down. It kind of creeped up all year, right? And then right at the end, it really went up. Because I've shown it here, right? So, so what happened? So the Fed kept doing, raising the rates. So there's a big thing in investing called "Don't Fight the Fed." So when the Fed does things, you really got to pay attention because the market moves a lot depending on what the Fed does. So they were doing rate hikes because inflation was high. So the Fed raises interest rates to cool down inflation, right? The economy is hot, inflation is going up high. The Fed will raise the rates to make money more expensive, less investments, less, like less companies buying, getting money because it's too expensive. So it's kind of the way the Fed slows things down. So as you know, they were raising it a lot last year. Towards the end of the year, they talked about, well, we'll get there. Yeah, about stopping that. So so inflation hits a 2-year low. So they're raising rates. So inflation started coming down. Inflation was like over 8%, I think, at one point in 2022. The Fed likes it to be actually. Does anybody know what rate does what does the Fed like for inflation rate?
2%.
Very good, 2%. So they've been at 2% forever. It went up over 8%. So they want to get it back down to 2%. Anybody guess where it is right now?
7?
It's down
6.
to 3.2%.
Oh,
Oh,
Yeah, I was gonna say between 3 and 4%.
Yeah, a lot of people don't know that. They keep hearing inflation, inflation.
And it's come down a lot.
It's come down a lot. People don't know it, but it has come down a lot. Well, I'll show you that stuff too. But so it's really come down. It's just people don't know it. Okay, so June 13th, it hit a 2-year low. So October 19th, the 10-year Treasury yield hit a high of 4.98. I think it went over 5% at one point. So I'm not sure why they picked October 19th. So the 10-year Treasury is an important one. A lot of things based on the 10-year. So that's very high for the 10-year. I guess I talked a little bit about bonds. As interest rates go up, the yields go up, the bond values go down. And that's because if you think about it, say you have a $1,000 bond and you got it at 5%. Now the rates go up to 10%. Who's going to give you $1,000 for your 5% bond, right? Say, I want a discount. If you're going to sell me your bad bond at 5%, I want to pay a lot less money to get it, right? So that's why bond values go down when the yields go up and the other way around. So now as the interest rates come down, the yields come down, the bond values will go up. And then finally on December 13th, the Fed said, okay, they stopped raising them in October, I think. They raised them a lot fast, and then they leveled off. And finally, December 13th, they said, maybe we're going to cut. Okay, so they're finally over the hump. They have not cut yet. Today was the FOMC meeting, which is where they decide whether or not they're going to cut, raise, cut, or stay the same. So even today, they said they're going to stay the same. But they expect it. Any guesses? How many cuts do they expect this year? Has anybody heard any of those numbers?
3.
Very good. Somebody's got a lot of good answers here. They're still expecting 3. They say they're expecting 3. We shall see. And so as they start doing that, hopefully the market will start moving again. Okay, so quarterly earnings. So a big part of stock price is the company's quarterly earnings. Okay, so you can see, it goes down, it goes up. Obviously, COVID time, earnings went way down. So obviously, once COVID was coming back, ending, earnings are going to, it's the, how much it changed, right? So if it went down this much, it's going to go up that much higher, right? Because it was so much lower last year, it's easy to beat the next year. But now it's kind of leveling out, and it's been down the first few quarters of 23. It's actually at the very end, it went up a little bit. So this is a big thing for individual stocks. Like, it's if the company has earnings, hopefully the stock will go up. I think it went up 3.8 maybe in the fourth quarter, and they expect 3.3, I think, in the first quarter. So earnings are coming back. You know, the stocks have gone up a lot, right? The end of last year, beginning of this year, but now can the earnings match that is the question. So we shall see. Okay, so here are some of the numbers. So our GDP, the gross domestic product, it was 2.2. It's, you know, here it shot up, but it's back down to 2.5. So they're expecting, I think, in the low twos for the gross domestic product. Unemployment rate has been great. Inflation, as we saw, was 8. See, it's been coming down, coming down, coming down. So it's really gotten a lot lower. So the consumer sentiment index is how people feel. 100 is normal. So anything below 100 is the consumers are not feeling well. Anything over 100, they're feeling good. So these numbers are low, right? So even though people are spending money, the sentiment out there is kind of low. And the home builders are really hurting, right? I think it goes up to 100, but you know, the home builders are a little worried right now too.
So 100 is like content, but there's no like degree of variation of like in the happiness range? Or would you say like 80 to 100 is pretty good, or
100 is like you're, you know, I guess you're in the middle. Like, yeah, you're kind of happy, but not, you know, you're not excited, you're not worried. You're kind of like, okay, things are good. So these numbers are low, right? They've been low for a while. Okay. So it's, you know, people are worried about what the Fed's going to do. There's still a lot of stuff out there. It's an election year. There's, you know, Ukraine. There's Israel. You know, there's a lot of stuff going on. There's China. There's a lot of stuff going on. So people are very worried about things. Speaking of an election year, okay, I'll give you guys a quick test here. You think it's election year is good or bad for stocks? Any guesses?
Good.
Did somebody say good?
Bad. Bad.
You got a good and a bad. Okay. Here's the answer. Okay. As you can see, stocks are always good. Okay. So a pre-election year. So last year, okay, since 1928 to 22, there was to 2022. So there was 23 in there. There was 21 good years and 2 bad years. So we decided 23 was another year. So we actually had one more good year, right? Because 23 was good. So we have another good year. An average of 17.5%. It goes up. An election year is not as good, but it's good. Election years are good too, right? So of the 24, 20 were good years, 4 were bad years. Then you get the post-election year and the midterms are not, they're still better than, you know, good versus bad, but not as good because those are the years where things happen, right? Before the election and the election, you know, they want to do things to make it look good. So the markets move. Does that make sense?
yeah?
Okay. So where are we now? So this is a poll for you guys. Actually, we have 2 polls in a row here. Okay, first poll. Okay, so how comfortable are you investing in the market right now? Not at all. I'm just going to keep what I got. Cautiously interested in going in, or I'm enthusiastic. It's funny, I asked this question last year and the markets weren't doing well this time last year. So we had some interesting results. Kind of curious what's going to happen now because the markets have been doing well. But sometimes that scares people, right? The market's been doing so well, people get scared like, oh, it's going to crash now. Okay. Can end the poll in 5 seconds. Okay. So how'd we do?
58% are cautiously interested, with 25% keeping current and 17% enthusiastic.
Oh, interesting. So the market's been doing well, so it's, I thought we'd have more enthusiastic people. But
Cautiously enthusiastic.
there you go.
Yeah, I'm old,
is
I have to be
still-
cautious.
Exactly.
This is still better than, more positive than last year, though, when you did
No,
this.
last year was
webinar.
true. It is more positive. I should have put up last year's actually, but it's right. It's because the market's been doing well. So last year people were more enthusiastic than I thought they would be, because it was a really bad time last year when we did this. But you know, I was happy to see people were still interested, which we'll get into. Okay, so now there's another poll. Okay. Before I get into the economy, I want to ask you about it. Okay. First thing, taking politics out of the equation, right? Because people are like, I voted for that guy, so the economy's good. Or I voted for the other guy, so the economy's bad. That's not really how it works. So how do you feel, right? This is not, you know, hard numbers. It's just how do you feel about the economy, just, you know, for yourself. Okay, put up the poll here.
You should have a D there. We hate Trump.
I'm not getting into politics. I left you a space at the bottom. You can write anything you want. I asked you why. So, so just see how are you feeling about the economy right now? You're good with it? You think it's good? You think it's bad? Or you kind of, I don't really know. I'm kind of neutral. Okay, give you a little bit of time here. Okay. So how do we do?
54% neutral, 38% good, 8% bad.
Oh, okay. Interesting. Now we're going to get into it. I should have polled you afterwards, but I wanted to get your feelings beforehand. Okay, so let's take a step back to November of 2020. Okay, the reason we're going back here was what happened in 2020. What was the big thing in November of 2020? What was the big thing?
COVID?
COVID was still, it was ending. It was still strong, but what else happened? 4 years.
We elected a president.
Exactly. So this is right before the election. So we had a lot of politics going on, and COVID was still pretty strong. It was maybe starting to come out of it, but you know, it was still there, right? So very good. It was the election, because now we're 4 years later, so we're going to see where we are now, right? So okay. So what does this all mean? Okay. Green means it has a positive impact on investments. Yellow means it's neutral, and red means it's got a negative impact on investments. Over the next, this says 3 to 9 months. Okay, yeah, 3 to 6. I think it's really 6 to 9, but this is 3 to 6. Okay, this is a place called CNR. Okay, so monetary policy. What is that? So I guess I should explain monetary policy versus fiscal policy, because people talk about the economy and, you know, president does this or whatever like that. Okay, so let me give a little quick thing here. Monetary policy. Okay, the Federal Reserve Bank is responsible for monetary policy. Okay, so they're responsible for inflation and employment and all those things, right? The money supply they're also Federal Reserve. They also make sure there's banks, or banking system is sound, all kind of stuff. But monetary policy is what the Fed does, right? So inflation is actually the Fed. It's not the president or whoever. People always talk about it like that, but it's not really. The president and all that stuff is the fiscal. Okay, that's fiscal, that's monetary. Fiscal is budgets and taxes and all those things, right? That's the responsibility of the government, of the executive branch, right? All that stuff. And Congress approves all kind of stuff, right? So they're kind of different, even though they both have an impact. So back then, monetary policy was very good because interest rates were really low. Everything was going well. The economic outlook was a little scary because of COVID and everything else going on. The yield curve, was not quite good. It was not good. It was still starting to go up there because of issues. Consumer sentiment is 70% of the economy, or 75%, some in the 70s. 70%, 70+% of the economy is consumer spending. Okay, so and also GDP, right? 70% of GDP is consumer spending. So if consumers are not happy, they don't spend money, right? So it has a major impact. So it was getting, neutral, getting a little scary there. This is scary, just disposable personal income, because people were losing their jobs because of COVID, right? They didn't have money yet. Mortgages were low. The labor market, people were starting to get fired because of COVID, so that was going down. Consumer spending, again, they were losing money, so it wasn't that great. Interest rates were low. The taxes were being dropped, everything else, it was good. Businesses were starting to get worried, right, because COVID. Lending was happening because interest rates were low. Corporate profits were still there. This is because COVID didn't really impact them yet at this point. International economic was starting to look bad. Political was bad because election year. Inflation was not bad at all. Inflation was still 2% back then. Okay, credit, so companies could still, it was getting a little scary with borrowing, but it was there. Energy was, equity markets were starting to crash, and geopolitical risk, everything was going on with COVID and everything else. Okay, that was 4 years ago. So our next one here. So what happens next time? So we're jumping ahead to 2022. So this is right before 2023, right? We jumped here because
Wow.
2022 was bad. So this was what it looked like right before 2023 started. Okay, so just compare the two.
Not a single green in 2022.
Not a single green, right? So this is right before 23 started. So that's why, and the market was crashing, everybody's getting worried, right? So people were worried before. That's why we did this thing last year. People were worried about it, right? So monetary policy was really bad because they were raising rates all through 22. The economy looked bad. The yield curve, yields were going very high, right? Consumer sentiment was still, I'm surprised, not as bad. Actually, the economy's been doing really well because of consumer spending, right? That's really what's been holding it up. And labor, people have jobs, right? People lose jobs, they're not happy. So the labor market holds and consumer sentiment holds. That's why the economy did better in 23 than they expected. And that's why the stock market did so well. Disposable personal income was okay-ish. Because remember, people were getting money, stimulus and all that kind of stuff. Housing was bad because rates were high. The labor market it was not that neutral, but not that bad, right? Consumer spending wasn't that bad. Interest rates were going high. Fiscal, everything was going bad because of all stimulus, right? Business spending was down. Nobody's lending money. Corporate profits were down. The international economy looked bad. Political environment, a little better than it was, but not great. Inflation was looking bad. Everything's looking bad before 23, right? Okay, so let's jump now to January of 24. Okay, so we know 23 did really well, right? So what happens now for January? Okay, so the global economic outlook, not very good, right? Fixed income, because rates are dropping, as I talked about before. If yields go down, fixed income goes up, right? The value goes up. So fixed income is starting to look good. The equity outlook is still a little scary for the stock market, right? In January, even though it had just done really well first few months. Okay, so the next one here. So this breaks out again, a lot of yellows and reds, right? Still no greens. Beginning of this year, it was just 2 months ago, right? Still no greens. So let's jump to March. Okay, so now things are starting to look better. So this just came out. Okay, so the global economic outlook looks better. Like fixed actually became green, right? So they're doing really well. And equities are starting to look good again. Still neutral, but they're going the right direction here. And now if we look at all those numbers, this is for March. Remember, there was no greens. Now we're getting some greens, right? Consumer sentiment is back up again. The labor market, and you see the little gray bar is where it was the previous month, and now is where it is now. So it kind of showing you it's going up or down. So the consumer sentiment went up. Labor market's doing well. Consumer spending's going up. It's already in the green now. Inflation now, because as you saw, inflation was over 8%. Now it's down to 3.2%. There's still some problems with it. They were hoping to get it down lower. It's bubbling back up a little bit. So it's still, iffy there. But the equity market valuation, they think it's overpriced. And geopolitical risk, again, wars everywhere. Right? So there's still a lot of geopolitical risk. But it actually looks much better now than just 2 months ago, right? There's no greens. There's 3 reds and no greens. So as far as where things are heading, it looks good. Well, it's looking better. I shouldn't say it looks looking better. Okay, so there's the leading economic indicators. Okay, so there's a lot of economic indicators. Most of them are lagging, which means like what happened 6 months ago, right? There's also leading economic indicators, which are like employment, or purchasing agents for companies buying things, right? There's a lot of things that kind of like lead you to, will it look good in the future is kind of what they're basing it on. This actually takes into account stock market and everything else. So there's actually 10 things that are tracked in this leading economic indicators. This usually indicates recessions. Okay, it goes down. We had a recession. Goes back up. Goes back down again. There's a recession here, and then goes back up. Shot down here for a 2-month recession from February to March of 2020. Went back up. So it came back down. So this is why they thought there's going to be a recession, right? This is one of the main indicators to feel there's going to be a recession. So recession is 2 negative quarters in a row for gross domestic product, the GDP. If it's down 2 months in a row, we actually had that, but there was some nuance to it. So it's more than just the 2. I always thought just the 2 months, but I guess it's like English, right? I before E, except after C, right? So it's 2 months of down GDP, except if whatever. So it never really declared a recession here. It never happened, right? It didn't really, we kept talking about recession, but it didn't really happen. So this is maybe the first time it actually is not going to show recession. Now you kind of need recessions. There's a whole economic cycle that happens, and you kind of need to get into recession sooner or later, but they're not thinking it's going to happen right now. But it could change. Okay, so for 2024. What are the potential headwinds? So we know what could cause us problems in 2024. Inflation has gone down a lot, but it's still there, right? And you can still, it's not as low as the Fed wants. They want it down to 2%. They haven't dropped the rates yet because inflation is still kind of there. Is there a question? Okay. So the Fed policy, right? So are they going to drop today? Just today, they said they're still expecting 3 cuts this year. Okay. Corporate earnings, as you saw, the corporate earnings were minimal, right? They were positive the last quarter, 2 quarters, but they're not way up there, right? Other years. So there's still some concern about corporate earnings. The stock market jumped a lot end of last year, beginning of this year. Now they're wondering, are the corporate earnings going to bring it there, right? The market is anticipatory, right? People think it's going to happen. So they think the corporate earnings are coming and inflation is going to go down and the Fed's going to drop rates. If that doesn't happen, it may be, a headwind. It may be hard. New competition. So the competition is interest rates are high still, right? So you can buy a CD and get 4 or 5%, right? So we don't need to be in the stock market today because I'm doing well with CDs. So recession, like I said, it's the numbers, they don't expect recession, but it's always lingering out there. And obviously geopolitical tensions, right? There's a lot of stuff going on with Ukraine, Israel, China, a lot of stuff going on there. So these are potential things to cause problems. Okay, what about the tailwinds? Woo-hoo. What's going to help us? Okay, so inflation is going down, right? It's kind of leveled off a little bit, but it was 8, now it's 3. It's 3, went up a little bit, but it's, they expect it to keep going down. Artificial intelligence, that just, went crazy last year. And now they think it's going to, do better. Like, so NVIDIA, right? NVIDIA does chips for artificial intelligence. So, that's why they did so well. But now they're expecting a lot of other companies to start using artificial intelligence. Right now, it's the companies that like the back end for artificial intelligence, but now they expect other companies to start using it better. So just curiosity, is anybody out there using AI at all? Has anybody used like ChatGPT?
A little
Yeah, I
bit,
use it all the
very
time.
little.
You guys should try it out. It's really good.
It's really amazing. It is.
Just be careful. Make sure that information is correct. Just don't do it and send it out. But yeah,
There's a new one. There's a new one that's not ChatGPT. It's called you.com or something like that, that everything is kind of checked and researched.
okay.
So it's a lot better.
Yeah, so this is a generative AI. It basically goes at the internet up until 2 years ago and pulls all information and kind of like synthesizes it and comes up with it's like crazy how good it is sometimes. It's like shocking. You can even like, write a letter and say, hey, ChatGPT, make this better. And you can even say like, hey, I'm a financial advisor. I want to send this to my clients, make it better, and it makes it much better. So just try it out. It's really cool. But the problem could be is it gets information from the internet. And we all know what's on the internet may not be true. So, if enough people sway the internet to be one way, ChatGPT will go with that because that's what it says on the internet. So just be careful with it. But it's really cool. Just get an account and play. It's crazy what you can do with it. Okay. So tailwinds are higher profits. So they're expecting companies to have higher profits, which I'll show you in a minute. A more dovish Fed. So I don't know if you heard the term hawkish and dovish. Hawkish is when the Fed is raising rates, trying to stave off inflation, and dovish is lowering rates. So they're hoping for a more dovish Fed. And China's been in a recession. They're thinking they may pull out of the recession this year, and China delivers a lot of products to the world, right? So if they can get out of the recession, it should help everything on our end, right? Because the big part of the why inflation happened was because you couldn't get parts, right? And you could finally get parts, you couldn't unload them, right? All the ships outside of LA, right? There was like ships and ships and ships out there. So once they stabilize, it should help our economy and everybody's economy. Okay, so S&P 500 valuation matters. So the forward PE ratio. So PE is price earnings. So it's what is the price of the stock versus its earnings. Okay, so just to give you a feeling of our stock our stock's expensive right now. This is one way of looking at it. The middle row is the 25-year. So the S&P 500 PE is 16.76, averaged out over the last 25 years. But as you see, it goes high and it goes low. So right now, it shot down, COVID shot up, came back down. So it's kind of like almost right on it right now. So so it looks like the PE ratio is kind of where it should be. Okay.
You say so.
So let's look at the forecasts. Okay. So the quarterly bottom-up EPS. Okay, that's just looking at all the companies in the S&P 500, what their earnings per share is. This is not looking top-down. It's not looking at the economy. It's just looking at, the median for all the S&P 500, what the earnings per share should be, and that's what they come up with. So you can see it's been bouncing around, but they expect it to go up, right? The end of 23, then all of 24, they expect it to go higher. So they're expecting earnings per share to go up, which is what you want if you want to buy a stock. You want your EPS to go up. In theory, it should be doing better that way. So that's a good thing. But again, these are all estimates. Okay. So this is as of today, actually. I ran this today. So this is what people think the Fed funds rate. Does anybody know what the Fed funds rate is that they didn't change today? It's 5.25 to 5.50. I guess I should explain. What is the Fed funds rate? Why is it so important? The Fed funds rate is banks have to put money as reserve, that's why it's Federal Reserve, into the Fed every night, okay? And if they have excess funds at the Federal Reserve, they can loan it to each other. So you can borrow from if a bank needs money overnight, they can borrow from the Fed, but the Fed has a higher rate than the Fed funds rate. The Fed funds rate is what the Fed wants banks to charge each other, okay? They don't necessarily control it, but this is what you should be charging each other. So right now the Fed's fund rate is 5.25 to 5.50. This is what they've been raising. Okay. So they've been raising that number. So they expected them to cut it 3 times this year. So as of today, these are numbers I went for December 18th. So the Fed meeting of December 18th, what will the Fed funds rate be? Right now it's 5.25 to 5.50, which is over here. Okay. So it looks like people are really expecting it to come down. So people, think it's going to, by December, will be down to 4.50 to 4.75, doing the 3 cuts that they expect. So this is just kind of showing you the feeling is that the rates will be cut, and that should help the stock market. Okay, now the GDP, the gross domestic product, and unemployment rates. These are from February 9th, so about a month old. So these are showing you what the GDP is. So it's the 0.8% is going up to 2.1. So they think, their old estimate, they went much higher than their old estimate. So each quarter, well, the later ones I keep the same, but it looks like they think the GDP is going to do better than they thought it was going to do before. And unemployment rate, it looks like it's going to be a little lower. So these are all pretty low rates. These are good rates. So that looks promising too, right? So the GDP, it looks like it's going to do a little better. Unemployment is going to do a little better. So these are all like positive signs. But let's take a look at this. Okay, consumer spending. So as I said before, the consumer spending is it for the economy, right? It's over 70% of the economy is consumer spending and the GDP. So if you notice, people were saving a lot of money in 2021, 22, because they weren't going out because of COVID. They were getting stimulus checks. They're sort of getting a lot of money. So they actually saved money. But when they started to go out, guess what? It came down, right? So they didn't have excess savings anymore. So they revised it up a little bit. So the consumers have kept the economy going last year. Okay, that was the big piece. Employment was doing really well. Consumers are spending a lot. That's why the economy did so well last year when they did not expect it to. That's why we did not go into a recession. But if they're not having excess savings anymore, maybe they're not going to be so willing to spend, right? And also household debt. So this is from third quarter of 22 to third quarter of 23. It's not that it's not that much different for the first quarter, but so it's gone up. So student loans have gone up, auto loans have gone up, home mortgages have gone up, credit cards a lot, and all the other stuff. So everything, consumer debt is going up, their savings are going down, and their debt's going up. So will they be able to maintain the spending that they've been doing is the question. Because that's been keeping the economy going. So this is kind of worrisome. Okay. So I jumped to it quick. Okay. So this is what wait a second. I'm now confused what I wrote there. Oh, okay. This is the poll. Sorry, I thought I was giving the answer. This is the poll. Okay. So now that you saw all that information, I know it's a lot of stuff, I know. But first, is there any questions before I get to this question? Are there any questions about what I just went over? It was a lot of stuff.
Just absorbing it, Greg.
I know it's a lot of stuff. I'll send this out so you can look at it again.
Yeah, it's really interesting.
Yeah, but obviously nobody knows, but this is, so last year I asked you guys what you thought was going to happen for 2023, and we did better than the big guys. We thought it was going to do better than the big guys did. Okay. So I'm asking the same question again. Okay. So what do you think the S&P 500 will do in 2024? So it ended 2023 at 47.69. Today, right now, it's at 52.24. Okay, I just updated it today. So if the market doesn't move, it's 47.69. If the market goes down 10%, it'll be 42.92. Market goes up 10%. If you notice, that's basically where we are, right? If the market's up 10%, it's 52.46. We're at 52.24. So it's basically up 10% already. But it doesn't mean it's going to stay there. It could go down, right? Or go up 20%. Okay. These are just giving you numbers. Okay. So I'm going to do a poll. Okay. The poll is on. Okay, then I shut it down. You guys ready?
Go ahead.
Results. Okay, how'd we do?
69% of us think it's plus 10%. 23% of us plus 20%. 8% at 0.
And no negatives. Okay. We're enthusiastic.
Yes.
As we were last year too. So the biggest group is up 10%, but that's where we are right now. So, that's not unreasonable because that's where we already are right now.
Well, combined with your earlier slide about during election years, it goes up. That's why it could be more than 10%.
Exactly.
Right.
Some of you guys know it's 20. Woohoo. Let's hope.
Well,
Okay.
depends on who wins.
I was the person who did the 0%, and only because it's an election year.
Yes. Now I get it. But we saw the stats. It usually does well in election years.
That's true too.
I actually mentioned this. I'm a financial advisor, but I'm also not as much anymore, but a day trader. And during the election, oh boy, this is actually the election when Trump won. Okay. So a few years ago, the market was not expecting Trump to win, right? They were expecting Hillary to win. So I was actually trading a futures. Futures run like all day. So I was trading futures. And when they announced Trump won, the market crashed. Now, people don't know this because like the next day it was shot up, right? But when the news came out that Trump won, the market crashed. It hit the circuit breaker. It has circuit breakers that if the market goes down, whatever the number is, I forget whatever the number is, like 10, 20%, whatever the number is, it stops the market, shuts it down for an hour. Comes back on. If it shoots down again, another 10 or 20%, they lock it again for like 2 hours. Okay. They have all these circuit breakers. So the market crashed when it went down, whatever, 10%. When it came back up again, the market shut up. But it just, they weren't expecting it, right? So it was complete, the market likes to know what's happening. And you throw, curveball at the market, they just, they crashed it, but then it shot back up. I guess they realized in that hour, like, oh, this could be good. I don't know. So it was very interesting. Okay. So we're saying, we said up 10% or 20%. Well, those are the options I gave you. Let's see what the big guys say. Now, it's not fair because the market's already up 10%. So, we have the privilege of seeing the market up 10%. They did this in December or before December of last year. So the market wasn't even moving up much at all. So their numbers are going to be a little bit lower. So we're going at either 52.46 or 57.23. They're at 4,800, which is not much different because the market ended at 47. So they're basically saying, when they were doing this last year, November, December of last year, they were saying the market's not going to move. We're saying it's going to be up 10 or 20%. But, we have an advantage because it's already up 10. I'm sure these numbers I should have looked. What's that? No, I thought somebody, okay. So, what does this all mean? The value of discipline. So basically, the thing is, even though I was a day trader, it's time in the market, not timing the market. Okay? Don't be jumping in and out of the market. It's basically the rule here. And it's showing you here. So in a 1-year time frame, the market was up 69 times, down 25. In a 3-year time frame, it's down 16, up 84. Right? A 5-year time frame, it's down 11, up 79. And a 10-year time frame, it's down 5, up 80. So it's just basically showing you the longer you're in, of course, the rule, right? Past performance is not an indicator of future results, that whole thing. But just kind of showing you that the longer you're in the market, usually the better. And just to show you even more so, this box on the right is showing you if you put in $10,000 on January 1st, 2002, and then 20 years later, what happens? Is that 20? 20 years later. If you didn't touch anything, your 10,000 would be 61,000. If you missed 10 days, now they're the top moving days, but if you missed 10 days, your 61,000 is only 28,000. You missed the top 20 days, you're down to 16. Top 30, you're down to 10. Top 50, you're down to 5. If you missed the top 100 days in 20 years, your $10,000 is only $1,000. Okay.
Yeah, but how does that relate with inflation?
Well, then you'd be in worse shape because inflation is, it's dollars. A dollar then is, it's inflated. So this would be worse. This is just, what your account balance would be. So now, obviously, you're not going to miss the top 100 days, right? unless you're really bad. But they're showing here, people get scared, they pull their money out, because usually when the market goes down, it shoots back up, right? So, and me being a day trader knows this very well. It's easy to get out. It's hard to get back in, right? Once you're out, you're like, oh, but I'll wait another day. Oh, so that's where things go awry. It's hard for people. It's easy to pull out. It's hard to get back in. So, and if you miss the big days, especially I showed you the recession back in 20 because of COVID, 2020, early 2020, the market shot down, but it like shot way up. Once it started to move, it moved fast. And if you were on the sidelines, you missed that whole thing.
So Greg, you have mentioned like, because I'm like on the sidelines, you've been mentioning these like new tools that actually let you turn the dial to mitigate risk or increase possibility. Could you say something about that? Because it's so cool, I think.
I'm getting to those. Let me just showing you basically, again, this is showing the market, how, what it could be versus what it ended at. And those were, that's right. These are stocks, right? These are equities. This is fixed income. So in 2022, fixed income died, right? So careful. And this is your 60-40. A lot of people in retirement are 60-40, 60 equity, 40 fixed. So just showing you over the years. Normally they're, but they're both down here. The only year they're both down is 2022. Okay. Just quickly, in fact, the losses, if you lose 50%, you have to make 100% to get your money back. Right. So you got to double your money if you lose 50, which kind of makes sense, right? But you don't really think about it. You look at it. Okay. So we're talking about some products here. So, so you see, people are scared in the market because it could crash. It has crashed. So now there's some products out there that are available that based upon your risk tolerance, your desire for growth. There's some products out there now that have some flexible downside protection, including some that guarantee no loss, right? Guaranteed no loss, or 10% buffer or 20% buffer. There's all different products, many out there. And they also give you flexible upside potential that are market-based. Some actually beat the market. There's products now that if the market's up, will give you guaranteed X amount above the market. But they also give you some downside protection. So there's a lot of stuff out there. And a lot of them have no fees, no explicit fees. Some even give you guaranteed lifelong income, but with the fee. So there's a lot of products out there now. It's not just having to be in the market and crossing your fingers, right? There's things out there now that can, it locks up your money for a while, but there's, a lot of stuff out there to help protect. If you're scared about the market, there's a lot of products out there now to help you mitigate that risk. And to give you one example, this is a product out there. So it's a 6-year, you're locked in for 6 years. This has a 15% buffer and a 350% cap. So if the market is down, like here's the market's down 10.5%, less than the buffer, you don't lose a penny. Okay. The market's down 21%. It's a buffer 15. They take the first 15% hit, you take the 6% hit. Okay. So here you put 100,000 in, market's down 10.5, you still have 100,000. Here, the market, you put 100,000 in, you only lose 6% because they take the first 15. So you're down to 9. You lost 6, but you didn't lose 16. Or sorry, you didn't lose 21. You didn't lose 21. If it's the most common case, I guess it's in between. So the market made this, you made that. So the market made 280, you made 280, you're up to 380. And here, the market did really well for those 6 years. It broke the cap. The market was up 420%, but you get capped at 350. So you're stuck at only $450,000 instead of $520,000. I don't think anybody would complain about that. That's just one particular example. I know we're a little bit over time here. Oh, okay. I just want to quickly stay out of politics with your investments. Okay. People think, I'm not going to go in because this guy could win, or that guy's going to win, or that guy won, so I'm taking all my money out, that kind of stuff. It really almost doesn't matter. I know it sounds weird, but the politics don't really matter. It's just showing you here, this is the different cases here. Probably for 10 years, there was a Republican president, Republican Senate, a Democrat House. That was the best combination of all the combinations. Then Republican Senate. Then a Democratic president, Democratic Senate, Republican House was the next one for 4 years. So just showing you all the different, so there really is no, best one. And here's just showing you different presidents and how they did. Okay. The blue is Democrat, the red is Republican, obviously. So just showing you, so Reagan did this, but Bush did that. Clinton did that. W did that. Obama did that. Trump did that. Biden. Well, this is August of 2022. This has to be updated. It's going up now. I don't know where he is now, but it's up there. So the politics don't really matter. It's like stay out of it. Here's so Biden's up 24%. I don't know when this is as of. And Trump was up 67. Obama was up 166. W was down 37. Clinton was up 209. But you see, it's all combinations of not just the president, but who's in Congress, because they fight over everything. So basically don't let that drive you. Okay, so just to wrap things up. Oh, by the way, when we get out of here, there'll be a quick survey that you can take. As soon as I end the webinar, it'll pop up with the survey, so please take that. It's optional. Every question's optional. So basically, if you're my client, so just keep us informed of any important life changes. Tell us about your investment concerns and make sure essential documents are up to date. For me, it's keep you informed through regular communications, manage your investments according to your personalized strategy, and remain abreast of economic factors and adjust accordingly.
If
And,
somebody is not a client of yours, can they still meet with you and do that whole free going over their financial landscape?
oh yeah, totally. That's what I'm here for. That's what we'd have to do. We would meet and go over things and see if it's a fit or not. So that's how we do it. Yeah, so please contact
And
me.
if I may add, I went through that with Greg, and it was really beneficial, and I appreciated it. And his report after that session was really valuable. And before you know it, I'm working with Greg, and I have my total trust in Greg. So there you go, Greg.
Thank you, Mike. I was going to ask I didn't want to put anybody on the spot. But
Seconded.
so thank you. Yeah, I spent a lot of time, as Mike can tell you, I spent a lot of time with you, going through everything with you over and over again and looking at all the options. I guess I come from the tech world, so I'm analytical. So, I really maybe do too much. I look at so many options and really sit down with you and go over everything, see what, really fits best for you. So I'm hoping, when I work with people, they really understand all their options and why we went with what we went with. Of course, based upon the risk tolerance. So thanks, Mike. Any
Very
questions?
welcome.
Okay, so here, book a free consultation with me. We review your goals, needs, and dreams. I'm very big on your dreams, right? Why have money? Just have money. It's what do you want to do with it? And that's where I do like I said, I'm a behavioral financial advisor. Some people have actually gone through like values cards. I figure out your values and things like that. So if I haven't done it with you yet, we'll get to it. Understand your overall financial insurance situation. You need insurance too. Insurance is risk management. Okay. It's, why do you have insurance? There's many different types of insurance. And in fact, I think if they're still out here tonight, we had actually one of the carriers was out here with me tonight, a long-term care guy. So the long-term care is very expensive, right? So there's options to cover long-term care costs. There's options to cover death benefit, disability. It's, it's endless. So it's a big piece of the whole thing. Discover new ways to build your wealth and protect your assets, because you got to protect it too, right? Not just having it, you got to protect it. And it's important. What are your most important goals and dreams? So, consultation with greg.com, or give me a call or give me an email. And I think, yeah, so this is all of my contact information. Okay, I know we're a little bit over. Are there any questions?
Pretty comprehensive. It would be great to see the presentation, Greg. Thank you.
You're welcome, and I think it's recorded. So,
Thank
hopefully
you,
there-
Greg.
Okay, you're welcome.
Thanks,
And,
Greg.
And
Thank
hang
you,
on,
Thanks,
Greg.
Greg.
you're welcome, but hang on one second. Let me end this thing, and when I end it, you should get a quick survey. And fill that out. I'll be very
Right.
happy. Okay.
Thanks, Greg.